Hey there, morning everyone. Happy Monday. It is Monday, the 13th of July. I'm Mark Gardner. Welcome to MPC Markets morning call. Friday night wasn't that bad, but we're going to have stocks opening lower today as Hormuz shuts again. US and Iran memorandum of understanding is very much dead now. I think we're into our fourth day of attacks from the US. On Iran, roughly hit about 300 Iranian targets across multiple waves. Iran's retaliated across the Gulf, struck some military facilities in Jordan, Kuwait, Qatar, Oman, Bahrain, and Iran also closed the strait until further notice. US or Trump and CENTCOM have flatly denied this closure and says traffic is flowing. But the reality check to that is there was, from people on the scene, there was visibly zero traffic at all on Sunday. So again, I mean, we're up to about our 15th, 20th odd, claim from Trump publicly that Iran wants a deal. He's saying the strait's open. That is complete and utter crap. It is not open at all. There is no traffic going through, and attacks are back up to what was basically an average day from both sides in terms of, full-scale war. So no matter what Trump comes out and says, the reality is that oil prices are up around about 3%. Futures are fallen about 0.5%, and on the open. So really, this is not overly relevant. Although Meta got a really good upgrade from brokers just on the back of their CapEx and what they're doing to get some spending, or to make some money out of that. Their compute build out, etc. And then Nvidia was up on just a general rising AI sentiment. Nvidia's been kind of under the pump. Well, not under the pump, but under pressure lately. It certainly hasn't caught any of the bid like it has in the past. It's all been focused on the semiconductors index, which you can see was largely flat, except for SK Hynix, which debuted, which was the largest foreign IPO on Friday, which was just an ADR, which is a deposit receipt. So essentially, that's what companies do when it's a South Korean company. It's what they do when they want to dual list in the US. It's one form of it. And it was, it was up around about 16%, which I kind of get. It's a little bit difficult to invest in South Korea, but and it definitely adds further liquidity. They raised about 26.8 billion doing that, and but as you can sort of see, look, if you've got a lot of grey patches like that, it's generally a pretty quiet night overall. And I would expect, that really that Meta was the only real one with a catalyst, except for Netflix, which was down about 2.8% or thereabouts, because there was a research report out sort of claiming that, or predicting that we're going to have, that we're going to have lowering subscription rates overall. So bit of a nothing night, I've got to say. And we've still sort of got the Nasdaq and the Russell heading back in more to neutral territory on the technicals. Really didn't do much for the week. The Aussies sort of starting to improve a little bit. We were largely pretty flat. The Euro stock's coming off those record highs, and then the Dow's sort of been the better of the indexes of late, albeit that it's very, very different in the way that it's the way that it works overall and the weightings and things. So on Friday we did a podcast around market risks and called "Be Fearful When Others Are Greedy," and it was just really important to point out that whilst it's a bit of a fool's errand being bearish in any index market really overall, and it's fraught with danger trying to time those downside moves. But there was a few sort of things combining at the moment that did concern me. And over my 30 years in markets, when these things start to stack up together, the market can survive them in isolation. Don't get me wrong. And I'm not saying go out there and buy a short. I'm just merely saying that there are risks out there at the moment. and these risks combined give me a little bit of concern. So we've got record margin debt and retail leverage at extremes. So, which can lead to forced liquidations on any dip. We've got around record low levels of cash for fund managers, around underneath the 4% mark, is very much, is very much a low balance and more of a generally a sell signal at 4%. Now, I mean, look, it was at 3.3% at the start of this year, and we've gone up. So, like I said, in isolation, these are definitely not, they're definitely not reasons to sell. But what it means is there's no dry powder to buy dips. So the old buy the dip, you've got retail leveraged at extremes, which means, the reason you're using leverage is because you don't have enough cash generally, or you want to have a pretty decent crack at something. And then the fund managers have got no capital to buy the dip. So if retail is then being forced liquidated and there's no fundies to buy it, you're relying on passive and passive only. And there's still a lot of passive money around there, don't get me wrong. There's also low downside protection. So the put call skew, so puts are downside. You're buying puts, you're looking for the market to go down. Buying calls, you're looking for the market to go up. But the put call skew is at 0.7, which is near or at a record low, which means that basically most of the instos don't have any downside put protection. That also concerns me as well with that dry powder. There's corporate debt strain, and bid to cover ratios are falling for these big hyperscalers in terms of, when they're issuing their corporate debt. Amazon the other day had a really disappointing bid to cover ratio, which means that it was oversubscribed at a much lesser level. And I think we've got some earnings risk coming out from the hyperscalers, because I think this massive AI CapEx was already concerning a lot of investors. And then you've got the added expense now, where they're having to raise prices because of this memory shortage as well. So, but the memory shortage is not the only bottleneck that's out there at the moment. It's driving power prices higher. It's driving copper prices higher. It's generally very inflationary, and there's a lot of the GDP at the moment. So, we're just a little bit concerned that, whilst the hyperscalers might still beat it on the top and bottom lines, Wall Street will make sure that they do that. It's an 80% beat rate in the US, which means that their numbers are just they start too low essentially. But where we saw prices under pressure last earnings season was when their CapEx numbers came out. And look, their CapEx numbers for if they're expanding, are blowing out because of inflation in the particular things they need to do to get these data centers going. Investors are going to get very concerned because they're not going to get the same rate of monetization or net profit margins or even gross profit margins that they were going to get, because prices have gone up. And then add the geopolitical risks, and also then add the very reliable indicator of the midterm election year has had a 10% or more sell off from the highs, from the record high intra-year, every election cycle since 1939, and on average it's around about 16 to 17%. So I don't like all of these things together, is I guess what I'm saying. And we're looking at going back to decent amounts of cash. And look, if you want to get into any more detail on that, we've got a whole podcast on it. Kai and I cover it, and we go through all of those in detail. So you you can basically go to your favorite platform, podcast platform, and just search bulls versus bears or MPC markets, and you'll be able to find this. We do a sort of special topic every week. You can go back and have a look at some of the different topics we've covered over the course of, with things like software, space, IPOs, mega cap IPOs, etc. in the last month or so. It's definitely worth, definitely outside of just the weekly market catch up. There's definitely some decent focus topics that you can go, or you can go to npcmarkets.com.au/podcasts, or scan the QR code. Look, commodities, crude is going to be up. I think it's last check, it was up around about 3%. Futures, obviously, in the index indices was down about 0.5%. These risk off, which is a bit of an odd thing, but these risk off trades like these other commodities like gold and silver and platinum and things are down a little bit as well. I expect, excuse me, didn't get enough sleep on the weekend. I would expect to sort of head a little bit lower. We did have some real positive news around Aussie and India doing a uranium deal, which is really positive for uranium stocks on Friday. That index or that ETF that you can see there, the URA that was up 1.4, that would have been driven a lot by the Aussie stocks. They are quite a large part of the of that ETF. And look, lithium down for the week and sort of starting to make a bit of a recovery, but we're actually starting to look at some of those lithium names are starting to look pretty interesting. But yeah, we'll you can go to Mosaic, which is our platform, to get our recommendations and get a free trial if you'd like. They all come out via push notification or email directly to you. Global calendar this week, we've got consumer sentiment, NAB, business confidence today. Not much in terms of earnings. Tomorrow we've got we've essentially got, which will be tomorrow night, because these guys report on the earnings before the open, so you won't be able to react to that until Wednesday. But you've got all the banks, JP Morgan, well, nearly all the banks, JP Morgan Chase, Bank of America, they're just the biggest two, but you've also got Goldman Sachs, Wells Fargo, and Citigroup that day as well. Then we've got Johnson & Johnson, Morgan Stanley, a couple of the smaller, financials as well. TSMC will be a pretty decent one. That's during our sort of day session, or into the evening. United Health, which used to be one of the biggest healthcare companies in the world, has been on a bit of a recovery, which has been pretty good. Excuse me. And then you got BHP here in Australia with a quarterly. Netflix on Friday, which will be interesting to watch given that downgrade from the other week. So yeah, if you are a little bit concerned and you're holding ETFs in the S&P, we've due to popular demand, essentially, we ran this back in May. It was actually our biggest selling campaign ever. We've got a 3-year index investment called Buy the Dip, and essentially, there's an observation period from now until November, and essentially we elect a day in the week, and then during that observation period, if the market falls, your entry price for the 3-year investment is the lowest settlement price of that nominated day. So it takes the guesswork out of essentially buying the dip, because we all know when it gets scary, it's really difficult to buy the dip. There's an explainer video on that website, and you can go to mpcinvest.co/buy the dip, or you can scan the QR code, or you can go to mpc.com.au/index investment and have a look at that, because it's a really good strategy, and it's very capital efficient. It's only around about, it uses calls essentially to be leveraged long, but not obviously to the downside. So what you put up front's all your risking. It's about $17,000 per $100,000 worth of exposure or thereabouts. It does vary. It will probably be a little bit lower. We won't get a price until we're closer to the strike date. And look, and then you have that investment for three years, which is sort of takes advantage of the Trump put. He'll make sure that the markets. He will do everything he can to get markets up over the course of his presidency, I'm sure. But what it does is it makes it very capital efficient to represent the same views. So if you sold 100 grand worth of S&P 500 index ETF, for instance, you can put down a fifth of that essentially and get the same exposure. And then what you do with that other $80,000, I mean, you can go into some more sort of risk-free investments. You can buy some individual stocks, etc. But that's sort of up to you. So very capital efficient, very good way, and modern, new world way of doing basically the same thing, but just in a much more capital efficient, much more sensible and risk controlled way. and define your outcome before you invest. And look, if you think AI is a bubble, this is not a bad way to represent it either, because essentially, if the market does get absolutely tanked, you're only risking 17% of that notional exposure, as opposed to having all of your cash on the line. So it's a bunch of different things. So go to the website, have a look at that, or you can look at it on our YouTube channel, and I do a little 10-minute explainer, and you can get the PDF. It'll close in the middle, around the middle of next week. Certainly, expressions of interest, please get back to us as soon as possible. You can contact us on the website. In terms of anything today on the ASX, as I say, I think the geopolitical will essentially be the overriding. We'll see how we go in Asian markets just across the board, and oil, etc. I don't think there's much company specific that it's that will be about the only thing that saves it over in a broad sense. So hope everyone has a great day, and we will speak again tomorrow.